So over the past week, the rumours have resurfaced that Rachel Reeves may be looking to cut the cash ISA allowance. The latest articles are speculating that on the 15th of July at her Mansion House speech, she's going to announce a cash ISA allowance cut. Now, we don't know the details, or if indeed this will happen at all. It may turn out to be nothing. But if she does go ahead with it, maybe it'll be down to 5k, 4k, we don't know. The idea behind it is that maybe it'll push people into investing instead, because we all know, as if you're watching a personal finance channel, that long-term equities do outperform cash. That does not mean that I think this is a good idea. I think personally it needs to be accompanied by education. Forcing people to invest will not work, and cash ISA does have some uses for some people. However, in this video, I want to go through other alternative, tax-free, low-risk places to park cash for short-term goals, or just for cash that you don't want to take much risk or if any risk on it. And I actually want to show in this video how many options there are to store cash outside of a cash ISA, tax-free with low to zero risk. There's so many different options. And I think personally, if people are aware of all these other options, you don't actually need the cash ISA. There's so many different places that you can store cash, as I hope to show in this video. So first of all, I want to start off with standard savings account. You don't need to use a cash ISA. In the UK, we have something called a personal savings allowance. There's also a starting rate for savers, but for most people, it'll be the personal savings allowance that is applicable. And this is how much interest you can earn per tax year outside of an ISA tax-free. Now, for basic rate taxpayers, you can make £1,000 in interest per tax year tax-free. High rate, 500. Additional rate, unfortunately, 0. But for most people, it's going to be the basic rate and high rates that apply. And say you earn under 50k, the basic rate will apply. That's £1,000 in interest you can earn per tax year. To put that into perspective as how much savings you would need 25k at 4% interest rate to get to that 1k personal savings allowance. And 25k is a lot of cash to have. So you can kind of see how in a lot of cases, people probably use cash ISAs without realizing the tax-free benefit in that case is actually of no benefit to them because it would have been tax-free anyway in a standard savings account. So if the cash ISA allowance does get cut, what people can do instead, if they have £25,000 or less and get a 4% rate, they will be able to make that all completely tax-free as a basic rate taxpayer. So I would just use any website, any comparison website, Money Saving Expert, Raising UK, to find whatever the best paying, easy access savings account is. And you can simply put cash in there and then there you have it. You can earn interest tax-free. You don't really need the cash ISA. But what if you're in the higher or additional rates or you have more than 25k in savings that you want to store cash-free? What are the other options we have in the UK? Well, one option is to simply use a stocks and shares ISA and leave the cash uninvested, have it as uninvested cash in the stocks and shares ISA. Many stocks and shares ISA platforms offer interest on uninvested cash. For example, at the moment, at the time of recording, Trading 212 offers 4.35% on uninvested cash in their stocks and shares ISA. Now, this does involve use of cash and qualifying money market funds. So in that sense, it's actually not completely uninvested. Qualifying money market funds are a type of investment, so I would recommend reading about them. But I personally believe the more you learn about money market funds, especially qualifying money market funds, you can understand how very extremely low risk they are. And if qualifying money market funds fail, we are sort of in a global financial crisis. That's how safe these sort of investments are. Speaking of money market funds, you can actually just hold a money market fund directly inside a stocks and shares ISA. So you can invest in a money market fund yourself on any platform. Say, for example, you use Hargreaves Lansdown, Interactive Investor. One of the popular ones on there is the Royal London Short-Term Money Market Fund. Now, this is not a recommendation. I'm just using this as an example of a GBP Sterling Money Market Fund, just to show you how they work and what exactly is inside them. So on the fund fact sheet for the Royal London Short-Term Money Market Fund, we can see the fund's comparator benchmark is the Bank of England Sterling Overnight Interbank Average. So the Sterling Overnight Interbank Average is a measure of the rate at which banks lend money to each other overnight. It's sort of similar to the central bank rate. So if the central bank rate, Bank of England rate is 4.25%, the SONIA rate is usually about 4.19, 4.2, slightly below. But I do find that these money market funds usually slightly outperform SONIA, for whatever reason that may be, and they replicate the SONIA rate by investing in very short-term debt. If we scroll down and look at the asset allocation of this fund, we can see that it's in covered bonds, treasury bills, and cash instruments. Importantly, the duration profile is all short-term debt, so money market funds pick up any rate cuts or rate increases by the central bank rate very quickly. That's why a money market fund will always give you a rate return pretty close to whatever the central bank rate is at the time. The debt matures and it's replaced by debt issued at the new rate. And also importantly, the credit rating profile, money market funds usually contain debt from highly creditworthy institutions, banks, companies, whatever it may be. You can see here the credit rating profile. It's everything from AAA to A-, so highly creditworthy debt, very, very unlikely to default on their short-term debt. It doesn't actually tell us what debt instruments are in here, but it's usually short-term government bonds and then debt from highly creditworthy banks. Like we're talking high street banks or big financial institutions that it would take a sort of global financial crisis level event for them to default on their debt. And even if, say, one of them did default on the debt, the point of money market funds is they're diversified across all sorts of debt. So even then you wouldn't lose all your money. But we don't want to go too much into money market funds here. The point is, it's another option for very low risk, not zero risk, but another very low risk option to get tax-free returns, short-term returns, if you hold it in a stocks and shares ISA, of course. If you hold it in a general investment account, there will be tax to pay on the returns of a money market fund. But it's just that as a replacement to a cash ISA, you could hold a qualifying money market fund in a stocks and shares ISA if you're happy with that very small additional risk as opposed to cash. Another place to store cash tax-free is premium bonds. So premium bonds, instead of getting interest, you get the chance to win prizes. The current annual prize fund rate from August 2025 will be 3.6%. That does not mean you'll get 3.6%. It's prizes, so you get a chance to win. And usually with the more you have, you can hold up to £50,000. And the more you have, the more likely you are, with average luck, going to be getting that prize fund rate. There is a chance to win up to £1 million, but that is obviously incredibly unlikely, but it is a small chance. And you can see the odds to win are 22,000 to 1 for every £1 in the monthly prize draw. Now, with average luck, premium bonds aren't amazing, but the key thing is that it's tax-free. So even if you get, say, a 3.5% or 3% return on premium bonds, it's tax-free. So it's better than, say, getting a 4.5% return taxed at 40% in a standard savings account if you use your personal savings allowance. So for someone who's maxed out their ISA, use their personal savings allowance, premium bonds are another good place to look to store cash for short term. And as it is backed by the Treasury, you can say it's pretty much zero risk with premium bonds. Now, the last thing I want to cover, if you've exhausted all the other options, your ISA allowance, your personal savings allowance, your premium bond allowance, and you've still got some cash to spare that you need to park somewhere, you want some sort of return on it, but it has to be for the short term and you want it to be tax-free, something to consider is low coupon gilts. I say low coupon gilts because with low coupon gilts, sorry, sound like a broken record, most of the return is coming from the capital gain rather than the coupon. And there's no capital gains tax on gilts, UK government bonds. So, for example, I'm using Hargreaves Lansdown here just to show. We can see a treasury here, 0.125%, that's the coupon, and it matures on the 30th of January 2026. This is T26, and you can buy it at £98.32. And then on the 30th of January, it matures at £100. So that'd be a £1.68 capital gain tax-free over that 6-7 months that you hold it for, 6 months. Now, there is tax to pay on the coupon, but because the coupon is so small, there isn't going to be much tax to pay. And instead, all the return is coming from that capital gain, which is tax-free on UK gilts. And as far as risk goes, obviously, it's a UK gilt. If you think the government is going to default on its debt, then that is the risk, really. Is the UK government going to default on its debt? Let's all hope that won't happen. So you can say this is pretty much as low risk as it's going to get. Because if the UK government is defaulting on its debt, I'm not sure how good your FSCS protection on your savings account is anyway. So that was a whistle-stop tour of a number of places we have in the UK to store some money for tax-free returns with low to zero risk. And I just hope I showed that there are a lot more options beyond cash ISA. So worst case scenario, if the cash ISA allowance does get cut, we do have a number of other options available. So it's not the end of the world, but we'll have to see what happens. And of course, always do your own research into these options. Although we're talking about very low risk things here, I'm not a financial advisor. I have no idea what's suitable for you, but I hope this helps you with your initial research into other options beyond just cash ISAs. Thank you for watching and let me know your thoughts on cash ISAs potentially being cut in the comments below.